Hey folks, wanted to talk today around portfolio strategy and a huge risk, the number one risk to investors' property portfolio. It is debt. Now, debt comes in all forms, shapes and sizes. It could be a personal primary resident mortgage, it could be a personal loan, credit card facilities, overdraft, or private investor finance. I'm going to talk more around the fundamentals of utilizing this finance for buying a project, renovating a project, and exiting a project. You have ultimately three different sections for every project. You have the acquisition stage of negotiating a price, understanding the value in the purchase price and investment strategy of your project. For argument's sake, we'll just talk around our baby buy-to-lets. So we're going to be buying something probably probatey, distressed, not lived in for several months, if not years, and we're going to negotiate our acquisition finance for that. We're then going to need to have separate finance for the refurbishment. It can be our own cash and savings, it could be personal loans, it could be credit card facilities, or it can be private investor loan into the business. That refurbishment budget is critical because after we've bought the project property, distressed, tired, needs potentially tens of thousands of pounds being spent on it, we need to have those funds because otherwise we can't move it from a non-performing asset to a lettable or saleable asset, which is then going to start generating the revenue. So we've bought it, we've got our renovation budget, we execute on that over a period of 3 to 6 months, and finally the property is available to let or sell. Now, there are so many considerations here and compliance aspects that you need to go through from start to finish, but ultimately, purely looking at a finance point of view, we have our acquisition finance, which is relatively straightforward, but that is what it is. Okay, we're coming in at par there, buying the property for what we're buying it for. The adding value is the 25,000-30,000 pounds that we're going to be spending on renovating, new kitchen, new bathroom, electrical, plumbing, decoration, all that sort of thing. And finally, there will be an end value that we're relatively confident on. Obviously, you can't ever forecast the market where it's going to be in 6 months, 9 months, 12 months time. But we can be pretty confident if we are buying a very distressed property and we're spending a sensible refurbishment budget on it, key consideration here being sensible, we know that there is going to be some form of profit or equity built into that property at the end. And this property is then going to be able to be let or sold for a profit. And if it's let, the power of compounding over 5 years, 10 years, 15 years is really going to do wonders. And it's really, I implore people to go out and consider with an Excel schedule what it looks like over the next 10, 15 years, having that property let for the long term. After a pretty comprehensive refurbishment, obviously things go wrong, but you'd hope in the first sort of 5 years after replacing absolutely everything in a property that they're going to stay and that the issues aren't going to be as rampant as they might be as buying off the shelf, 5-year-old X already ran as a buy-to-let off the shelf investment. Biggest risk in delivering this project is the acquisition finance and the refurbishment finance. We need to be, as investors, very aware of what our end value is. Okay, and if a property is worth £100,000, it does not make sense to buy it for 70 and spend 50 on it. Buy it for 70, spend another 50, £120,000. It's worth £100,000. It is fine if you're funding that from your own means. You will live if you're funding it from your own means. You will not live if you're borrowing that money to deliver that project. So when you are borrowing funds from credit cards, private investors, most importantly, you need to be absolutely certain that your end value does support the investment that you're going through. Typical numbers we see them day in, day out. It's a 60k purchase, it's a 25k refurbishment, and it's a 100 to 130k end value. It's boom, 1, 2, 3. Relatively low risk from a development point of view because clients are kitting out kitchen, bathrooms, decorating. So that's relatively low risk from a development point of view. It's not subject to planning, there's nothing like that. That then make things more complex, obviously more profitable, but more complex. Occasionally more profitable, not always. But utilizing this short-term debt is a massively powerful tool, provided you are able to repay that more expensive short-term debt after delivering the project. So there are certain luxuries that renting a property affords, being once the property is rented, it starts to bring in revenue, rental income, which can then help sustain the finance costs. But if those finance costs are 8, 9, 10+% on the whole amount, they're unlikely to cover the whole cost. So the most important thing is being able to not only deliver that scheme, but refinance the property onto more sensible debt, 3, 4%, always stress testing at 6% to make sure that with rate rises we're safe and we're covered, especially in the inflationary environment we're in at the moment, but to make sure that the expensive debt is repaid and we can sit and we can wait for the power of compounding and rental increases to really work in favour for the investor that is outlaid these tens of thousands of pounds. Real challenge for investors is buying a property, not being in control of moving it from the distressed liability status as an asset, and it's not producing for whatever reason, moving it to the point where it has been renovated, it's available for let or it's available for sale, and is then a performing asset. Again, when you're selling, the reason I don't like it, you're not massively in control of finding the next buyer. Mortgages are taking a hell of a long time to go through just on a buy-to-let basis. So, being in control of getting a tenant in sooner, fine. You could potentially have heaps of equity tied up, but this is for me, the investment strategy here is to build an income that comes in every single month, okay, in the form of rental income, and just building and building and building and letting that compound over the years. Part of the problem with investors where we see people getting tripped up is that they aren't in control of moving from point A to point B. And that can be for a number of reasons. It could be for the planning strategy that they were going for, offering and taking the planning risk, and planning wasn't forthcoming or took much longer to come through. Renovation budget is another. Being able to fund that full renovation and moving from unlettable to lettable or not an attractive purchase to an attractive home, that's really the fundamental, and it's all about being able to move through that process without incurring too high a finance cost. Now, finance costs are going to be there. Seldom are you going to find a project that you can fund for 0%, but the fundamentals of being able to purchase, add value, and exit, it's the 1, 2, 3 basics that every single project needs to have a clear framework for. When we're speaking to clients all the time, they're saying, "Oh, well, it's a beautiful property. It's got lots of potential. I could do this, I could do that, I could do the other." That's fantastic. You've got lots of options. But from an underwriting point of view, we need to understand and have certainty that this is what we're doing, because the costs are going to vary significantly depending on which strategy you go with. So you need to know, and we need to know as a potential lender, that the money that's required to move from non-performing to performing is available. And it's so hard to get certainty on that when there's so many different options. If it's just a bog standard modernisation and renovation, you've got a kitchen, a bathroom, boiler, plumbing and electrics and decoration to sort out. If you're putting a 2-story extension across the back of the house, it's a very, very different budget, very, very different GDV, but very, very different budget. So whilst the GDV might be lovely and fantastic, you need to focus on the refurb budget to make sure that you can actually deliver this scheme and not get greedy, because there is always the attraction for doing that much more. But if that means you've got to go through planning, and planning takes 9 months, and even then you've got to go through appeal, you can very easily drown in these finance costs. So getting sensible debt finance and being in control of repaying that debt finance at the end of the scheme is critical. And this is something that we're looking for in our borrowers, as well as when we're carrying out our own projects. I'm sat in Streatham at the moment. We're going through that process. We've had planning permission granted. We've bought this on a PPR basis, so very, very low finance costs. We've got a couple of tenants with us. Again, reducing those finance costs. So we can sit and we can go through planning. We've been here for 12 months so far. It's probably a 6-month build, but making sure that we're in control of repaying those build funds is fundamental to success in this project. It doesn't make sense to be here spending £500,000 on the renovation. You're not going to get that back. The GDV doesn't support it. We'll be at a point where we've bought for X, we spent 500k, and the value's down here. Well, how is our funder being repaid? Now, we're not funding this out of cash. It's a private investor loaning in. So that means that we need to be in control of the discrepancy in the middle and spending 250 that we're confident we can get back from a refinance at the end, and really managing that process and being realistic with what stacks up is really what investors are doing. It's not only about seeing the potential profit in a scheme. It's seeing also the potential risks, and so many of those risks sit around debt and borrowing costs through the life of the loan. Just going slowly, cookie cutter, baby projects at a time, or something that you're comfortable with, whatever that is for you. If it's 3-bed houses, if it's a dozen apartments, don't go and leap into 24, 36, 50 apartments. Slowly grow, and that's really going to protect your portfolio and help you reach success over the long term, rather than gambling, putting it all back on the table with each project. Thanks for tuning in. I hope that's been interesting. Bit of a rambling around risks, portfolio strategy. This is going a bit more of an advanced topic, but there will be more basic stuff coming to the How to Get Started on Property series. So please keep your eyes peeled for that.